What's up everyone, it's Angel Palacios and welcome back to the channel. Today, we're diving headfirst into the world of finance. Whether you're just starting out on your financial journey or you're a seasoned investor, understanding key financial terms is absolutely crucial. So, in this video I'm breaking down 14 essential financial terms that everyone should know in just 10 minutes. Let's get started. Alright, let's kick things off with the basics. Money, it's something we all use, but how often do we really think about it? We earn it, spend it, save it, and sometimes even stress over it. But what is money really? We use it every single day in countless transactions. From buying groceries to paying for a cup of coffee, money is an integral part of our daily lives. It's so ingrained in our routines that we often take it for granted. But have you ever stopped to think about what it actually is? Beyond the paper bills and metal coins, money represents value. It's a concept that has evolved over centuries, adapting to the needs of societies and economies. Essentially, money is anything that's widely accepted as a form of payment. It could be cash, digital currency, or even something as simple as a promise written on a piece of paper. The key is that people trust it to hold value. It acts as a medium of exchange, a unit of account, and a store of value. These three functions are what make money so powerful and versatile. As a medium of exchange, it facilitates trade by eliminating the inefficiencies of barter. As a unit of account, it provides a common measure for valuing goods and services. And as a store of value, it allows individuals to save and plan for the future. This multifaceted nature of money is what keeps our economy running smoothly. Without money, our economy would be reduced to a chaotic barter system. Imagine having to trade your skills or possessions directly for everything you need. It would be incredibly inefficient and time-consuming. Trust me, you don't want to be trading chickens for a new phone. Money simplifies these exchanges, making it easier for us to get what we need and want. So next time you pull out your wallet, take a moment to appreciate the complex system that makes it all possible. Now, let's talk about equity stakes. Imagine you've got your eye on a company and you believe in its potential. An equity stake means you're buying a piece of ownership in that company. This could be through stocks, private equity, or even real estate. The bigger your stake, the more you own, and the more you stand to gain or lose as the company's value fluctuates. Okay, nobody likes talking about recessions, but understanding them is crucial. In simple terms, a recession is a period of economic decline. Think of it as the economy catching a cold. We see businesses struggling, people losing jobs, and overall economic activity slowing down. Recessions are a natural part of the economic cycle, but they can be tough to navigate. Chapter 4, Shares. Your ticket to the stock market. Now let's dive into the world of stocks. Stocks, also known as shares or equities, represent ownership in a company. When you own a share, you own a piece of that company, no matter how small. When you buy shares of a company, you're essentially buying a tiny slice of ownership in that company. This means you have a claim on part of the company's assets and earnings. These shares are traded on stock exchanges like the New York Stock Exchange or the Nasdaq. These exchanges provide a platform for buyers and sellers to trade shares in a regulated and transparent manner. The price of a share fluctuates based on supply and demand. Various factors influence this, including the company's performance, investor sentiment, and broader economic conditions. As a shareholder, you get to participate in the company's profits or losses through dividends and stock price appreciation. Dividends are periodic payments made to shareholders out of the company's profits, while stock price appreciation refers to the increase in the value of your shares over time. Investing in stocks can be a powerful way to build wealth over the long term. However, it's important to remember that with the potential for high returns comes the risk of losses. Therefore, it's crucial to do your research and consider your risk tolerance before investing. Diversification is a key strategy in managing investment risk. By spreading your investments across different companies, industries, and asset classes, you can reduce the impact of any single investment's poor performance on your overall portfolio. Remember, investing in the stock market is a marathon, not a sprint. Patience and a long-term perspective are essential for navigating the ups and downs of the market and achieving your financial goals. Chapter 5. Debt, not always a bad thing. Debt, the word itself can send shivers down your spine. But here's the thing, not all debt is bad debt. Debt is simply money that you borrow and are obligated to repay with interest. It can be a powerful tool when used responsibly, like leveraging debt to buy a house or invest in a business. However, high-interest debt, like credit card debt, can quickly spiral out of control. Chapter 6. Stock Market, where companies go public. The stock market can seem like a mysterious beast, but it's actually pretty straightforward. Think of it as a giant marketplace where companies can sell shares of ownership to the public. Investors buy and sell these shares, and the prices fluctuate based on a whole bunch of factors, like company performance, economic conditions, and investor sentiment. Chapter 7. Forecast, predicting the financial future. A financial forecast is like having a crystal ball for your finances, except, a little more reliable. It's a prediction of future financial performance based on historical data, market trends, and a whole lot of number crunching. Businesses use forecasts to make informed decisions about budgeting, investing, and planning for the future. Chapter 8. Profit Margin, the Holy Grail of Business. Profit margin is the lifeblood of any business. It tells you how much profit a company makes for every dollar of revenue it generates. A high profit margin means the company is killing it, while a low profit margin could signal trouble. Investors pay close attention to profit margins because it's a key indicator of a company's financial health. Chapter 9. Investment. Putting your money to work. Investment simply means putting your money to work for you. Instead of letting your cash sit idly in a savings account, you're putting it into assets like stocks, bonds, or real estate with the hope of generating a return. Remember, investing always involves some level of risk, so it's crucial to do your research and invest wisely. Chapter 10. Bankruptcy is a legal process that individuals or businesses go through when they can't repay their debts. It's basically a way to hit the financial reset button. Bankruptcy can be a complex and stressful process, but it can also provide a fresh start for those struggling with overwhelming debt. Chapter 11. Dividends are like little bonuses that companies give to their shareholders. When a company makes a profit, it can choose to reinvest those profits back into the business, or distribute a portion of them to shareholders in the form of dividends. Dividends are typically paid out in cash, but some companies also offer stock dividends. Chapter 12. Pre-tax profit before Uncle Sam takes a cut. Pre-tax profit is a company's profit before income taxes are deducted. It's a measure of a company's profitability from its core operations, and it gives you a clear picture of how much money the company is making before the government takes its share. Chapter 13. Annual turnover, the revenue game. Annual turnover, also known as revenue, is the total amount of money a company generates from its operations over a year. It's a key measure of a company's size and scale, and it's often used to compare companies within the same industry. Chapter 14. Return on Investment, ROI. Measuring your success. ROI is like the report card for your investments. It measures how much profit you've made on an investment relative to its cost. A high ROI means your investment is killing it, while a negative ROI means you're losing money. Understanding ROI is essential for making smart investment decisions. And there you have it, 14 essential financial terms broken down in just a few minutes. We hope this comprehensive guide has demystified some of the jargon and made the world of finance a little less intimidating. Whether you're a beginner just starting out or someone looking to brush up on your financial knowledge, these terms are fundamental building blocks that will serve you well. I hope this video has given you a clearer understanding of these key concepts and empowered you to take control of your finances. Remember, knowledge is power, and the more you know about how money works, the better equipped you'll be to make smart financial decisions. From budgeting and saving to investing and planning for the future, these terms are your toolkit for financial success. If you found this video helpful, don't forget to smash that like button. Your support helps us create more content that can help you navigate the complex world of finance. We love hearing from our viewers, so feel free to leave a comment below with any questions or topics you'd like us to cover in future videos. Subscribe to the channel for more awesome content. We're constantly working on new videos to bring you the latest tips, tricks, and insights into managing your money effectively. By subscribing, you'll be the first to know when we release new content, ensuring you stay ahead of the curve. and hit the notification bell so you never miss an upload. This way you'll get instant updates whenever we post a new video, keeping you informed and engaged with the latest financial advice and strategies. Thanks for watching, and I'll catch you in the next one. Until then, keep learning, stay curious, and take charge of your financial future. Goodbye for now.